You're listening to the Dominion Business Advisors podcast, where legacy-minded business owners find clarity, confidence, and biblical wisdom for building and exiting well. Hosted by Teich, a Christian kingdom-driven advisor, certified exit planning advisor, and founder of Dominion Business Advisors. This show is designed to help you grow the transferable value of your business, prepare for what's next, and finish the race with purpose. Each episode offers practical insight into exit planning, business strategy, and the team of professionals who walk with you on the path from success to succession. This isn't just about selling your company. It's about stewarding what God has entrusted to you and using business as a tool for impact that lasts beyond the bottom line. Let's dive in.
Welcome back to the Dominion Business Advisors podcast, where we help faith-driven business owners like you grow transferable value, plan your exit with wisdom, and leave a legacy that blesses beyond the bottom line. I'm your host, Teich, a certified exit planning advisor and founder of Dominion Business Advisors. In this special series, we're talking about centers of influence, or COIs. These are the key professionals every owner needs for a successful business transition. Today's focus, the CPA. If you're a CPA, this episode will show how you can move from compliance to legacy building advisor. If you're a business owner, you'll see why your CPA must be central to your exit plan. We'll cover the CPA's role before, during, and after an exit, how taxes and deal structure shape your legacy, and how we partner with CPAs to protect value and steward the transition. Because finishing well is not just a business goal, it is a kingdom responsibility. Let's get started. Let's start with where most people don't start, and that's before the exit. In fact, this is where most business owners and even many advisors miss the mark. See, the biggest mistake I see is business owners thinking exit planning is something you do when you're ready to sell. But here's the truth. By the time you're ready to sell, your ability to influence taxes, timing, value, and outcomes is severely limited. Exit planning is not a transaction. It is a multi-year process, and your CPA should be there from day one. So what does that look like? Early CPA involvement means strategic input on entity structure, owner compensation, capital expenditures, and depreciation schedules, all of which affect value and tax outcomes. Our Dominion Exit Readiness Blueprint flags whether the CPA is a proactive strategist. If the answer is no, we flag it, and we bring the CPA into the strategy room. And if the CPA isn't a strategic thinker, we help source one who is. This isn't about blame or judgment. It's about building the right team to serve the client well and steward the transition wisely. We have a saying that every exit is a tax event wrapped in a life transition disguised as a business transaction. If you're a business owner and your CPA isn't helping you forecast and model what a future sale or succession might look like, then you really don't have an exit plan. You have a hope plan, and that's not good enough. All right, so let's move from the planning phase into the actual transaction window. At this point, the exit is real. We're getting offers, negotiating terms, reviewing letters of intent, and gearing up for due diligence. Too many exits go sideways, not because the deal wasn't good, but because no one thought through the structure of the deal from a tax lens. And trust me, buyers are thinking about their taxes. You had better believe you should be thinking about yours as well. Some of the key roles the CPA plays during the exit include, number one, deal structure input. One of the first questions we ask is, are you selling assets or are you selling equity? That one choice can be hundreds of thousands or millions of dollars in tax difference. This is where your CPA's input is critical. We need to model the tax implications of both options, and sometimes even negotiate purchase price adjustments to account for unfavorable tax outcomes. We're not just negotiating the sale, we're engineering a tax-efficient outcome that aligns with your life goals. Number two, purchase price allocation strategy. Buyers and sellers both have to allocate a total sales price across different asset classes, like goodwill, inventory, equipment, and non-compete agreements. That allocation determines how much you pay in capital gains versus ordinary income. It affects your depreciation recapture. It even impacts your ability to use certain deductions down the road. And here's the kicker. Buyers and sellers don't always agree on how that allocation should be made. This is where your CPA becomes your advocate, making sure you're not taking on an unnecessary tax hit just because the buyer had a more aggressive accountant on their side of the table. Number 3, due diligence support. Buyers want clean books. They want trailing 12, 24, or even 36-month financials. They want financial statements that match tax returns. They want normalized earnings with add-backs and adjustments. If your CPA has been passive up to this point, or if the financials are a mess, buyers will notice and they'll chip away at your valuation. But when your CPA is in the loop early, when they've been helping clean up the books, adjust EBITDA, and prepare for due diligence, you gain a level of credibility that boosts buyer confidence. And buyer confidence increases purchase price and deal speed, period. And finally, number 4, closing readiness and tax projections. When the deal is nearing the finish line, one of the most important questions we ask is, what are the actual net proceeds you'll receive and when will you owe taxes? We work with CPAs to estimate those numbers as accurately as possible. Why? Because your post-exit lifestyle depends on it. Too many owners celebrate the headline number, but forgot what actually hits the bank after taxes, fees, escrows, and clawbacks. We don't let that happen. And I'll say this to any CPA listening right now. When you're included from the start, you're not just running tax returns, you're building lifelong trust. And owners don't forget who helped them keep more of what they built. Now let's talk about something that gets overlooked all the time. What happens after the exit? For most business owners, the closing table feels like the finish line. But from a planning standpoint, it's really just the start of a new chapter, especially for your CPA. Let me explain. When you sell your business, you're not just liquidating an asset, you're stepping into a new identity, a post-exit wealth holder. And that shift comes with a whole new set of tax, cash flow, and planning dynamics. This is often a huge transition, and your CPA is the one most familiar with your financial past. That makes them a critical player in helping you navigate your financial future. Here are just a few of the strategic touch points where we lean heavily on the CPA post-closing. Number 1, estimated tax payments. Depending on how your deal was structured, you may owe taxes in the year of sale or over time. Number 2, charitable planning. If charitable giving is part of the client's goals, the CPA becomes an essential guide in executing tax-efficient strategies like donor-advised funds, DAFs, charitable trusts, or gifting appreciated business interests before the sale closes. Miss the timing on this, and the tax benefit is gone forever. That's why we don't just bring the CPA in for tax filings, we bring them into the vision and value conversations as well. Number 3, installment sale strategy. Some deals include seller financing or structured payouts over multiple years. That's a whole different tax animal than a lump sum payment. We rely on the CPA to model cash flows, track payments, and coordinate with the financial advisor to maintain alignment across all moving parts. Number 4, real estate, depreciation recapture, and asset tracking. If the business owner has real estate and the deal includes the sale of that real estate or depreciated assets, the CPA becomes vital in calculating recapture taxes, opportunity zone eligibility, and how to reallocate proceeds into other tax-efficient vehicles. This isn't just closing the books on a business, it's opening the books on an entirely new portfolio, and we need the CPA's help to do it right. Here's the big idea I want to leave CPAs with in this section. Post-exit is your moment to shine. If you've mostly done tax prep and bookkeeping for a client in the past, this is your chance to step into a strategic advisory role. Most clients aren't thinking in tax terms after the sale. They're thinking, what do I do with this money? Or what do I owe? Or can I give some away? Or what's safe to spend? Or how do I not blow this? That's your opening to deepen the relationship and to continue serving the client well into their next season. And we want to help you do that. At Dominion Business Advisors, we don't disappear after the deal closes. We walk with our clients into the next season of life, and we want their CPA right there with us. If we've done our job right, the owner has more clarity, more peace of mind, and more confidence than they've ever had about their finances. And when the CPA is part of that story, that trust lasts a lifetime. So if you're a CPA listening to this, or if you're a business owner who relies heavily on your CPA, this is where I want to speak plainly. A lot of CPAs get left out of the exit planning conversation until it's too late, and that's a lose-lose situation for the owner and for the CPA. It happens all the time. A client sells their business, gets a huge liquidity event, and only then does the CPA find out about it, after the deal is closed and the tax bomb is already set in motion. At that point, it's not planning, it's reporting, and often it's damage control. At Dominion Business Advisors, we believe in a better way. We see the CPA as a strategic asset in the exit planning process, not just a compliance partner. We don't need you to master exit planning, but what we do ask, and what your clients desperately need, is for you to be aware of their exit horizon, know when your client is in the 5 to 10 year window, and speak up when it's time to bring in a bigger team. So with that in mind, here are a few key things every CPA should know when it comes to exit planning. Number 1, you don't have to do it all, but you do have to recognize the signs. You're already in the best position to notice when a client is entering the pre-exit window. If they start talking about slowing down or hiring a GM so that they can step back, or saying, "I'm tired of carrying this alone," those aren't just casual comments. Those are invitations to ask deeper questions like, have you thought about your exit timeline? Or do you know what the business is worth? Or do you have a plan in place? If the answer is no, that's your moment to refer them to a value advisor like us. Number 2, you're not going to be replaced. This is very important. A lot of CPAs worry that when an exit planning consultant shows up, they'll get sidelined or cut out of the client relationship. Not here. At Dominion Business Advisors, our job is to make you look like a hero. We want your expertise, your historical knowledge, your insights into the client's books. You bring continuity, credibility, and depth that no outsider can replace. We're not here to take your role. We're here to support it, amplify it, and protect the client together. Number 3, you have a strategic opportunity post-exit. Most CPAs want to grow into more strategic roles, especially as more compliance functions get automated. The exit is your golden opportunity to step into that role. Once the business is sold, the client still needs help. They need help managing liquidity events, tracking installment sales, handling charitable gifting, and coordinating with investment and estate planning professionals. You're perfectly positioned to be their ongoing guide, and partnering with a firm like ours makes that transition smooth, confident, and collaborative. Number 4, you can expand your value without expanding your liability. Exit planning is complex. Valuation, deal prep, tax modeling, estate planning, it can feel overwhelming. But here's the good news. You don't have to be the expert in every category to add strategic value. By knowing when to bring in a specialized team, you avoid liability, deepen client trust, and position yourself as the go-to advisor who connects the dots. Our team at Dominion Business Advisors operates with full transparency and signed mutual NDAs. We document our scopes, protect your role, and work with you, not around you. So to all the CPAs listening, you don't need to know everything about exit planning. You just need to know this. When you recognize the signs early, when you're proactive instead of reactive, and when you're willing to collaborate, you become more than a number cruncher. You become a trusted steward of your client's life's work. And that is a role worth playing. So now that we've established how important CPAs are to the exit planning process, let's talk about how we work together in real life. We use a defined framework called the Value Acceleration Methodology. Every engagement we run follows a structured process rooted in the Value Acceleration Methodology, which is a proven framework designed to grow transferable business value, increase owner readiness, and ultimately guide a successful exit. And CPAs aren't just peripheral players in that process. They're essential team members. Here's a quick look at how that plays out. Phase 1, Discover, which includes the Exit Readiness Blueprint. This is where we begin every client engagement. We assess 4 dimensions. Business attractiveness. Is this business something that someone would want to buy? Personal readiness. Is the owner ready to exit? Financial readiness. Do they have enough to fund their life after their exit? Business readiness. Is the company actually transferable? During this phase, we review tax returns, P&Ls, balance sheets, entity structures, owner compensation strategies, and distribution histories. This is where we loop in the CPA right away. We ask, what's been done so far to plan for a future sale? Or where are red flags in the books that could scare off a buyer? Or are there tax strategies that we need to consider now, not later? The CPA helps us establish a foundation of clarity. Phase 2, prepare, which includes the strategic roadmap and value growth actions. Once we've assessed the gaps, we co-create a roadmap with the owner, spanning 12 to 36 months to grow value and reduce risk. This is where the CPA gets pulled into more specific projects, like reviewing and cleaning up financial statements, normalizing EBITDA, helping us prepare sell-side financial diligence packages, modeling the tax implications of various deal structures, and advising on potential reorgs or restructures that could unlock future flexibility. We hold regular strategic planning workshops, monthly or quarterly, depending on the engagement level, and CPAs are invited to participate as needed. No surprises, no silos. We also coordinate software access and shared workspaces when appropriate. Everything's documented and centralized, which makes it easy for the CPA to collaborate efficiently without scope creep. Phase 3, decide, which involves exit execution and post-exit transition. When the owner is ready, we guide them through the actual transaction or succession. During this phase, CPA involvement is mission critical. We rely on the CPA to review LOIs and purchase agreements with a tax lens, help allocate purchase price across asset classes, provide or confirm adjusted financials and due diligence materials, track proceeds, installment schedules, and payment terms, and help the client prepare for estimated tax obligations and post-exit filings. We also bring the CPA into post-exit strategy meetings, alongside estate planners, wealth managers, and other professionals, helping the client reframe their financial picture after liquidity. We're not just building a deal or transactional team here. We're building a legacy team, and the CPA is one of the central parts of it. We bring deep expertise in value growth, exit planning, succession strategy, and owner psychology, but we don't pretend to be tax experts. We know what we don't know, and that's why we value your input so highly. We ask questions, we listen to your insight, and we do our best to make your job easier, not harder. So if you're a CPA who wants to serve your clients more deeply, if you want to be a part of a trusted team that protects your clients' wealth, honors their legacy, and brings excellence to the table, we want to work with you. Let's do something great for our mutual clients, together. Whether you're a CPA, a business owner, or even another advisor listening in, one of the most important things you can do is recognize when the timing is right for exit planning to begin. Because, let's be honest, owners don't usually call their CPA and say, "Hey, I think I'm like 3 to 5 years away from an exit. Can you help me get that ready?" Just doesn't happen that way. Instead, the signs show up in a casual conversation, tax prep meetings, or end-of-year planning reviews. The cues are there. You just need to know what to look and listen for. Things like when the owner starts talking about stepping back, or they're over 50 and still have no succession plan, or their net worth is heavily concentrated in the business, or they're already getting inquiries from buyers or competitors, or they're afraid of taxes. As a CPA, you don't have to convince them to sell. You just need to invite them to explore. Say something like, "It might be a good time to get a baseline valuation or exit readiness assessment, just to see where you stand. I work with a firm that specializes in helping owners prepare for transition without rushing into it." That's it. You've just turned a passive concern into an actionable next step, and you positioned yourself as a guide, not just a reporter. The biggest regret we hear from owners is, "I wish I'd started this process sooner. They waited too long. The market shifted, their health declined, our key employee left, the books were too messy, buyers lost confidence, and the opportunity passed." Don't let your clients fall into that trap. At Dominion Business Advisors, we believe in planning early, exiting wisely, and stewarding what God has entrusted you to build. That doesn't start with a deal. It starts with a simple conversation. And now for some final thoughts. If you're a CPA and you have clients over 50 with growing businesses who are asking the right questions but are unsure of their next step, let's connect. We're not here to pitch a product. We're here to build a team, to come alongside you, honor your relationship, and serve your clients with excellence. Let's build something that lasts, together. Thanks for listening to the Dominion Business Advisors podcast. If this episode struck a chord with you or brought you some clarity, I encourage you to visit dominionbusinessadvisors.com, where you can access our free guides, checklists, read our blogs, schedule a call, or reach out directly. Don't forget to subscribe, leave a review, and share this with a business owner who needs it. And remember, you were never meant to do this alone. Until next time, keep building a business that blesses beyond the bottom line. Clarity, confidence, legacy.
You've been listening to the Dominion Business Advisors podcast, where we don't just talk about exit planning, we deliver what every serious business owner truly wants: clarity for the journey, confidence in the process, and a legacy that lasts. If that's what you're after, know this: there are 100 consultants who can help you sell your business. But how many of them steward your vision, your values, and your victory from beginning to end? How many align their strategy with Christ and His kingdom? How many bring order to the chaos, integrate your advisors, and see the whole picture, from the numbers to the narrative to the next chapter? That's what we do. That's who we are. That's Dominion Business Advisors. So if you're ready to stop drifting and start designing the future you were called to lead, don't wait. Leave a 5-star rating and review to help others find this message. Then visit dominionbusinessadvisors.com to access the tools, roadmaps, and strategies we've crafted to help legacy-minded owners like you exit with purpose and finish well. You were never meant to do this alone. And now, you don't have to. We'll see you in the next episode.